Right, everybody, it is 5 minutes past 4 in Kenyan time and 5 minutes past 2 straight out of London here. So let's get started. Just got to start off with the risk warning, obviously, first. Bit of house cleaning. Yeah, so once you've gone through that, it's just basic leverage products, CFDs. I'm sure you're all well aware of that. Let's go into the actual start of the presentation, into the exciting nitty-gritty stuff. So from the very start of your trading journey, the essential basic underpinning to lay the foundations, you have to know what your reason is for trading. And it could be many reasons. It could be you want to create wealth, you want to become financially independent, you want to discover a second source of income, or you just want to take a punt and speculate. Whatever reason you pick, the reason why I mention this is because whatever reason you pick will affect the way you trade. So you've got to know this from the outset. And you know, the reasons behind our trading, they can define our trading strategy. The other consideration is, how does your trading fit with your personal circumstances? So your lifestyle and personality, how much time can you feasibly dedicate to trading? You know, monitoring a screen, do you want to trade more longer term? The other important requirement is to be aware of are your capital needs. So you never want to be using money that you need to live or may need at a future point, so your daily living expenses or retirement. Now, the beauty of trading with margin is that it allows one to dramatically lower the funding requirement to get started. However, it does also increase the risk of losses. Hence, it's always important to have a good strategy and to know what you're doing. And as the presentation today progresses, I'll get onto the value of a demo account where you can actually mess around before you use live money. So as we move on, so also, this is a mind game trading. You have to get your mind in the right frame before you start. You want to declutter your mind so you can really sharpen your focus just on trading. You've got to remove all the white noise, as they call it, and just really hone in on your trading. Panicking helps no one. Having a strategy and solid risk management can really help keep your nerves under control, especially when a big risk event occurs and volatility and price swings all over the place. You also don't want to become emotionally attached to any trading position. You need to have this sort of robotic, no emotions at all. You have to be able to cut a position if needs be and view it as just any other trade, just a number. And don't let fear paralyze you into action. Positions are going to go against you. That's part of trading. No one has a 100% win rate. If they did, I'm sure we'd all be buying their book or paying them to trade for us. And as I mentioned earlier, the usefulness of a demo account. You should definitely be starting off with a demo account to become familiar with not just your strategy, but also how the plumbing of trading actually works. You know, putting that order in, the position size, implementing a stop loss. It's nothing worse than making a silly mistake and losing capital when it could have been avoided using the demo account while you find your feet and dip your toes in the water. And as I say, you can also test and experiment with your strategy. So it's very, very useful, a demo account. Now we get into a bit more of the risk management side and the nitty-gritty of that. So how much of your capital are you risking on each trade? Well, most traders out there, most good professional traders recommend only risking about 2% or less of your capital base per trade. You pick your entry point and then you set a stop loss or level you'd exit the trade, combined with your position size to determine your risk value per trade. Now, some of you may be wondering why 2%, it might just seem arbitrary and random. Well, as I'll show on the next slide with a nice little graphic, there's a non-linear relationship between losses and the required subsequent gain needed to recover from the loss. What I mean by that is, as your losses get bigger, your gains have to be even larger to offset the fact that you're working now from a smaller account balance to regain and break even. Now, the probability of recovering and becoming profitable after a large loss becomes harder and leads to more reckless trades as you take on more risk to try and make those larger gains to recover those losses. Suitable position sizing helps control risk and maximize returns. Too big and we risk blowing up our accounts and not being able to trade again. too small, and we could be limiting our profit potential. So we've got to find that sweet spot that maximizes our profit while protecting our capital. But like Goldilocks' porridge, not too hot, not too cold. So instead of taking one large position, what you could do is you could split it into multiple units, and you can trim or enlarge depending on market conditions. That gives you a lot more flexibility. So instead of saying maybe using like one lot, you could do 5 0.1 lots. So you've got 0.5 lots, and then you can trim and expand depending on what your specific needs are. So this is the graphic I was referring to. As you can see, 1% loss, you need a 1% gain to recover 5%. But as we go further down on the loss spectrum and you really take a big loss, you can see that the gains required to recover those losses sort of exponentially rise and are much larger than the losses. So 50% loss, you need 100% gain. And you don't want to be in that position at all. Having a good strategy, risk management, and I'll run through that a little bit later on the presentation, a few more different ways in which you can monitor your risk and manage it, are key to sticking around in this game. Right, the essentials of a good trading plan. So you've got to develop a trading strategy before you start trading and stick to it. You know, following a formula is better than sort of trading erratically on whims. It also helps you structure your trade with entry and exit levels predetermined, reducing the likelihood of poor trades. Another big tip is don't be a jack of all trades and a master of none. Spreading yourself too thin by trying to trade every market, rather when beginning, focus on one, Forex, for example. Once you feel comfortable, you can start to branch out to other markets. You know, you might start to feel a bit overwhelmed when you're having to monitor loads of different screens, of different instruments, and it's always good to become quite intimately knowledgeable on a specific instrument or specific area of financial markets, such as Forex or commodities, so you could do gold and oil. And then really important is an understanding of the risk to reward ratio. You know, the risk is just simply the distance from your entry to your stop loss. And for any of you who don't know what a stop loss is, who are brand new to trading, stop loss is basically just an automatic level whereby you will instruct your broker or on your trading platform to essentially close the trade and get you out if it moves in the wrong direction or the direction which you didn't anticipate it to go. So it's essentially what you could lose. The reward is obviously the distance from your entry to your profit target or where you close the trade, essentially just the profit you could make. You should be aiming for a risk reward ratio of at least 1 to 2. This then gives you a cushion in the form of needing a lower win rate and enough of a profit to cover your trading costs, which I may add are actually very low at Pepperstone. Here's a graphic to show the risk reward table. So as I was saying, you know, larger risk reward, you've got a lower required win rate. Now the win rate percentage, all that simply is just you tally up all your trades. So I take 10 trades, and out of those 10 trades, I win 5 and I lose 5. So my win rate would be 50%. Now, if that was my win rate, I'd need just a 1-to-1 risk reward. Now, the reason, as I said earlier, is to have a 1 to 2 is it lowers your required win rate. You don't need to be some absolute omnipotent force who can predict every move in the market. You just have to get 33%, which is 1/3 correct, if you have a good risk reward ratio. So yeah, very important understanding that, important to staying in this game over the longer term. And then finally, the review process. It's very important to actually understand where you're potentially going wrong and where things are going well. So what I'd recommend you to do is to document your trades in an Excel spreadsheet, to review it and learn from your strengths and mistakes so that you can improve over time. It'll also allow you to collect data such as your win-loss ratio percentage and your win rate percentage and various other data points. You should include your entry, your stop loss, your profit target, your time frame that you traded on, so daily, 4 hours, hourly, etc., and the instruments of which you traded. You can also include a little bit of detail about what happened on the trade once it's closed. So you could say something like if you went long the US dollar CAD, and then price went down after a strong retail sales release in Canada, you could say, right, I was expecting that retail sales release to be lower than expectations, and therefore the dollar was going to strengthen against the Canadian dollar, but I got that wrong. So you just have a bit more informational content that you can work from. And from this data, you should be able to see what time frame you're most successful on, as well as the asset class which you're most profitable with, etc. You don't get better simply by doing, but by continuously reviewing your progress and refining your strategy and honing your skills. All right, that's pretty much it for the presentation side of the slides. Now what I'm going to do is I'm going to take us through to my MetaTrading platform, and I'm just going to run through particularly what I think about when I trade, what my process is, and just give you some insights into what I do as an analyst. So before I get into the nitty-gritty of the charts, what I would suggest is you need to keep abreast. For me, I keep abreast of all the important news on the instrument that you're trading. And some really good sources to do that are Bloomberg, Reuters, Financial Times, Twitter. Twitter is absolutely fantastic. It is one of the greatest sources. I cannot emphasize Twitter enough. It's one of the greatest sources for financial news. And it comes at absolutely zero cost. Follow a couple of good guys, set some notifications, and you will get a constant stream of valuable information that will help you in your trading, and it will help you in your learning process. Pepperstone also produces research. My colleague Chris Weston produces a daily fix, which you can sign up for via email, and I'm in the process of creating a weekly one on a Friday, whereby I go through sort of the dollar, euro, US dollar, pound dollar, and any other interesting FX pairs that have been moving for that week. So it could be US dollar CAD, it could be Aussie dollar, US dollar, it could be US dollar, Japanese yen. And then I'll look at gold, oil, and Bitcoin. So there's a little bit there for everybody, and we're going to get that up and rolling soon. But in the meantime, if you join our Telegram channel, which is also very valuable around massively important events, we post any important releases, fast moving data, and we give like a little 2-3 liner with a chart. Very, very valuable. And it also will notify you when we have provided any other analysis that we put up on the website. So a very, very useful tool, that Telegram. Zero Hedge is another really great source of information. If you weren't aware of that, they cover everything: financial markets, geopolitics. Really, really good. Then, okay, onto the chart. So what I like to do is I like to look at the charts, and I like to zoom out first. I like to look on a weekly basis, and that gives me the bigger picture and the bigger levels. Oh, sorry, gives me the bigger picture and the bigger levels. Let's jump. It gives me the bigger picture, bird's eye view, and the bigger levels to trade upon. Okay, and then from there, I can zoom further in to go lower down the time frame to the daily chart, which is actually the chart that I like to trade off the most. Sorry, I don't know. Okay, which is the chart that I like to trade off the most. I find it the most useful time frame, and for me personally, you can go further down. You can go down into the hourly, 4 hourly, to get a different perspective too. So yeah, there's a lot that you can do with that. And then you should always know your exit levels before you start trading. You should always know your exit levels and your stop loss, where you're going to exit the trade, etc., etc. So there's different ways to set up your stop loss. You can do a time stop loss. If the trade doesn't move after a week or so, or 2 weeks, whatever time you decide to choose, if it's just range bound, you can cut the trade. You can do a support and resistance stop. So for instance, if I was looking to load up a long position here, I might put my stop loss just below the support level at 121 here, 121.6. And it would work the same way for if you were shorting around here and there was a resistance level here, you could put up just above there. You can do a percentage stop. You could do 2% of your risk capital. So you would essentially just work out how many points, what your dollar risk is, depending on your position size and the pips away from your stop loss, and that's how you would calculate that. You can do an indicator stop loss or profit target, whereby you could do a moving average crossover where you could exit the trade depending on, let's say, if the 50-day moving average crossed below the 200-day moving average and you were long, you could say, right, that's a bearish sign, I'm going to get out of the trade. It could be when the RSI moves out of the overbought and comes back down out of overbought, you could start to go short. You can do a trailing stop loss. That's important if you want to let your winners run instead of a static stop loss, where you can essentially do it. You can customize it actually on MetaTrader, allows you to do that, whereby you can do 100 pips, 200 pips, anything you want really. It's really customizable. And you could do it as a percentage of the average true range indicator or a multiple of the ATR. And the ATR, essentially, if I was to just add that to my chart, I'll just show you that very quickly. The average true range. So essentially what this shows us is right now, it is at 60 pips basically. So it's on a 14-day period and it's 60 pips. That's essentially what price is moving around at on average. Now, as I said, you could go 2 times ATR, so that would be about 120 odd pips that you could set your trailing stop loss or even your static stop loss. Or you could take a percentage of it, 1%, 2%, 5% of your ATR. Yeah. Okay. And I think what's really important is, as a newbie trader, to be aware of is what's called stop loss hunting. Now, what the big fish in the sea in the financial markets, what they tend to do is they know that traders will put their stop losses around round numbers or just below support and resistance. So what they'll do is they'll push price below that point. They'll take out your stop loss, so your sell orders if you're long around here, and they'll push price down low and they'll get in a better price, the big institutions. So to avoid that, what you should do is you can essentially widen your stop loss, but obviously to still keep your risk per trade the same, you would lower your position size. So have a larger stop loss so you don't get always stopped out, and just have a slightly smaller position size with that wider stop loss. And the last thing I want to say on this topic before I go into like how I analyze the charts and why I have these specific moving averages on the charts are, you never want to lose money on a winning trade. You know, once the trade's working quite comfortably in your favor, what you should be doing is you should be moving your stop loss up to your entry point, because you never ever want to lose money on a winning trade. That's one of the worst things that can happen. And as I said, using multiple units, because it's quite difficult to decide on where you're going to exit a trade. That's probably one of the more harder things in the market to do. You know, you think, oh, should I let this run a bit longer, or should I take my money now? Am I being too greedy? And as I was referring to earlier in the slides, is by using those multiple units, having 5 0.1 lots as opposed to just 1 lot contract, you can actually trim some of those positions on the way up, and thereby you bank some money and set it aside instead of giving back potentially your gains that you've had and being too greedy and then moving against you. That is a very effective way to sort of let your winners run, but at the same time actually pick up some money while you are letting those winners run. So now for me, now what I've got on the charts here is I've got a downtrend line. So I wanted to see here when price got back up to here in end of April, I wanted to see if it broke that downtrend line, which it did, which was important because it tested it there at 3 points and then broke through there. I've got the light blue line is the 50-day moving average, and the dark blue line is the 200-day moving average. Now, the reason why I use those specific moving averages is because institutions look at that. Big institutions like your JP Morgans, your Morgan Stanley, your Goldman Sachs, they all look at those period moving averages as potential buying and selling points. They're also slightly longer the time period slightly longer, so the trends that form are longer term, medium to longer term. It's slower moving, so it's not like as sensitive as the pink line, which is a 21-day exponential moving average. Now, the difference between the exponential moving average and the simple moving average, the light blue and the dark blue lines, is that the exponential moving average weights values or data points, more recent data points, far more heavily in the calculation, whereas a simple moving average just weights it equally across all data points. So if you've got a 50-day moving average, it'll just divide by the last 50 days, whereas a 21-day exponential moving average will weight those maybe past 3 to 5 days far more importantly in their calculation, and therefore it's far more reactive to price moves as opposed to those two lines, which are far more slower and passively moving when price reacts. It also acts quite nicely as a dynamic support and resistance, the 21-day moving average. As you can see, price came, all the lows of those price candles came down and tested those that 21-day exponential moving average. Now, I quite like the RSI as a momentum indicator, and I'll tell you why now. It's very diverse. So it gives you obviously your standard over 70s overbought, below 30s oversold. But now what's interesting about the RSI is you can draw trend lines on it. So look here, price is making higher highs, but the RSI is making lower highs. Now what that says to me, it's not a guarantee, but it can be quite powerful as an indicator for you as a trader. What it says to me is that upward price momentum is actually weakening slightly because the RSI momentum indicator isn't confirming with those higher price highs. It's actually making lower price highs. And this little bearish candle we've seen today could start to be could be the beginning of maybe the euro US dollar pair rolling over here. The other thing that I like about the RSI is that you can actually draw in like a resistance line, which I've drawn in here, which shows if you go back to September 2020, every time price rallied, it came up against this 58 horizontal dotted line I've drawn here around 60, and all the price peaks were sold down. So that can also give you a sort of an indication of where the trend is and how important this is now. You know, the RSI is hovering very close to that. We can get some dips below it and some false breakouts, you could say. But on the whole, it is a very, very useful indicator. And then the Fibonacci here, you can see I've drawn in the little Fibonacci, the 38.2% retracement level, and price came right back down there at that 38.2% level and respected it. I've also got Bollinger Bands, which looks like a bit like brown sandy color on a beach in the Bahamas. And that is essentially just a measure of volatility. Now we know that this middle line of the Bollinger Band here, that's the moving average, the 20-day moving average. And essentially these outer lines, they are 2 standard deviations away from that moving average. Now, I don't know if any of you did statistics at school, but 2 standard deviations essentially captures 95% of the data points away from the mean. So if it's moving above that Bollinger Band, the upper or the lower line, we know that this is quite a rare move because, as I said, 2 standard deviations tends to capture 95% of those data points away from the mean. And you can use that sort of as a mean reversion strategy. You know, you could combine it with, if it shoots right above there and it's overbought on the RSI, that you should start ringing some alarm bells in your head saying, hang on a second here. If I'm long, this is potentially a point that I should be starting to trim my position or close out. Or if you want to be short, you want to express a short view, you could be starting to think, I should be maybe starting to take a little nibble here at implementing a short. And yeah, that's pretty much how my analysis works. I like to keep it simple. I think the analogy, keep it simple, stupid is great. You don't want to overcomplicate your trading because remember, technical analysis relies on that sort of momentum and other people doing similar things to you. So if they're looking at moving averages and price levels like support, which are important, that is going to push price in either direction. I also wanted to emphasize a very useful tool to you as a trader is the calendar, an economic calendar. If you're going to take trading seriously, you have to know what the biggest events are and what's moving on the calendar. So what's quite useful here is they show the priority and the importance of the event with these little dots here. So this event here, if you're trading the peso in Mexico, GDP obviously is a really big data point, and it's got the three little lines there. As you can see, we got the forecast and we got the previous, and then we got the actual, which came into print. Trying to show you some other ones, some different currency pairs. I think on Friday we've got the US, we've got that US, sorry, Friday 28th of May, yeah, we've got that US PCE deflator number coming out, which the Fed looks at very carefully, which sort of guides them in terms of how they set policy and interest rates. Let me just get to it here. There we go. So the core PCE price index. Now, strangely enough, MetaTrader hasn't actually made a big deal out of it, a priority, but in my opinion, it is a priority, especially now with inflation being such a large talking point in the market. Going from there, there's another useful tool which I'd like to show you. It's called Auto Chartist. Now, it's a sort of automated program. You can still do the trading, but it automates some of the price levels for you and just adds another tool to your toolbox in terms of how you would perform your analysis. So let me just go on the navigator window here, drag across the Auto Chartist onto the window here. Okay, here we go. So let's, for instance, look at, what should we take a look at here? It's a nice pair. Euro AUD, let's take a look at that. What's that? So it shows us there's a big box here. Maybe I can actually show you a better pair which has a pattern in it. That might be a bit better. Just give me 2 seconds to get this. Okay, so AUD JPY, rising wedge. Okay. So as you can see, it's drawn it in here. Now what the grey block represents, let me just switch to, just get this out of the way. Okay, so essentially they draw in that blue line and the green line, and they're showing you a rising wedge. And this grey block is essentially their profit target. Now also you can look at the pattern details, which is quite interesting, and it gives you the quality, the strength of it. And the breakout potential, the clarity. There is a video, we've got a YouTube video on Pepperstone's YouTube channel, which goes into far more depth than I have the time to do here on the webinar. And we also have a back testing video on YouTube, which will show you how to back test a strategy that you want to test. So for, let's say, for example, it's very simple. It could be you just want to buy when the moving average crosses above the other moving average. And you can go back historically and test that. And we have a good video explaining all of that. So these are all of the tools that Pepperstone provides you with to enhance your trading experience and make you a better trader. Auto charters, back testing, economic calendars. We provide you with good solid research my colleague and I produce, and various other presentations that we perform throughout the year, which really does help your trading experience. In terms of other discussion points, I think that's pretty much it from me. If you have any specific questions, feel free to write it in the box there, and I will do my utmost to answer it. Hi guys, I'm just going through your questions if you can hear me typing and answering them all. And yeah, if you can hear me typing away. Okay. Okay, guys, I'm just going to run through how to use the Fibonacci indicator, which I find is a very useful tool in trading. Get the euro US dollar up. Okie dokes. Okay, so you go to insert, you look for indicators, and then you go down to seem to have lost my old chart where I did have it on. Apologies. Here we go, objects, sorry. So when using the Fibonacci, what you need to do is you need to take the, so if I was looking to go long and buy the dips on this move, and I thought that this was just an overextended dip in the euro US dollar, what I'd do was I'd take it from the swing high, it's called, and then I'd move it down to the swing low. So let's say I just, for argument's sake, I decide to call this the swing low. So yeah, this is swing low, this is swing high, and essentially what I'm saying now is, okay, so actually let's say I want to short, and this is a retracement of 23% of this price move, this is a retracement of 38.2%, this is a retracement of 50%, 61.8. Now the ones that tend to be the most popular, the 38.2 and the 50%, that's where you tend to see the most. As you can see here, this is broken right through the 61.8% Fibonacci retracement level. So looking to short the rallies here doesn't look to be working out too well on the euro US dollar pair if you're looking at that way. Obviously on the previous chart that I had up, that was looking, this was the swing high, and I put the swing low down around here somewhere, so that's why I was showing 38.2% here as the retracement level, but obviously now I've just changed it up to show you quickly. And yeah, it's just important support and resistance levels where over time they've found that the market tends to sort of gravitate towards, besides obviously the specter of round numbers, so your like your 1.20, your 1.21, or your 1.25. Yeah, that is the Fibonacci retracement tool, and it is a very useful tool to add to your trading toolkit. So guys, if there's no more questions, then I guess that is it for today's webinar. I hope you've thoroughly enjoyed it. If you do have any more questions, please send them before I close the webinar. If not, please feel free to reach out to the team, and I will send over the link for the Telegram, the daily fix. I'm just going through the questions quickly now. You can watch this. If you weren't able to take notes, you can watch this on our YouTube channel. I'll get a list over of people to follow on Twitter that I think will be good for you guys as beginners, and the Telegram channel link as well as the daily fix. I will send all of that over for that. So I hope you guys have had a great, fantastic time today, and you can understand my strong South African accent. I hope it's not too strong for you guys and girls. Yeah, if you've got any other questions, I'll give it about another 5 minutes before I close it off. But I hope it helps you on your journey to trading with Pepperstone. All right, everybody. I'm going to sign off now. As I said, I really had a good time doing this. I hope you found it valuable. And please, if you don't receive that stuff, just reach out, drop us an email, the Kenyan team, and we will get all of it. I've made a note of everything that needs to be sent over. It's the YouTube link to the YouTube channel, Telegram, how to set it up in a link, and the daily fix, as well as I think that was everything. The list of people to follow on Twitter. So yeah, okay, everybody, cheerio.